Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Western Union stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Western Union offers money transfer services. You can send money to pretty much anyone, pay bills, check exchange rates, track a transfer, and a lot more, all from your smartphone. You can also go to a physical Western Union location at Walmart, Walgreens, and many other stores. It has over 40,000 locations in the US. The company dominated the American telegraphy industry from the 1860s to the 1980s, pioneering technology such as telex and developing a range of telegraph-related services, which included wire money transfer, in addition to its core business of transmitting and delivering telegram messages. After the company experienced financial difficulties, it began to move its business away from communications in the 80s and focused on its money transfer services. I'm sure you can imagine email was a big reason for the decrease in demand for its telegram delivery services. The company exited its communications operations completely in 2006 and is now the second largest money transfer provider in the world. It is headquartered in Denver, Colorado, and was founded in 1851. It trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, Sao Paulo, and London Stock Exchange. Let's get started with the model. This is a mid-cap company, 7.3 billion market cap. They're trading at $18 a share, and they have 402 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow grew a lot from 500 million to 800 million. Then it's been pretty steady after that. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's pretty steady year to year. It did peak in 2019 at 1.1 billion. It's currently 814 million. Revenue is the sales for the company, and that's pretty much flat, around $5 to $5.5 billion a year. So there's not much growth with this company. But stable revenue and cash flows is much better than declining revenue and cash flows. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Cost of labor is a big cost of revenue for this company. Revenue minus cost of revenue gives you your gross profit. And that's pretty steady each year, around $2 to $2.2 billion. Below that is their operating expenses. Marketing is a big operating expense for this company. Gross profit minus operating expenses gives you your operating income. That was a little over $1 billion in the trailing 12 months. They paid $108 million on the interest payments on their debt, which is the lowest amount they paid in the past few years. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. They pass through lots of gains and other income or expenses. These are gains from the sale of some of their investments. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which looks pretty good year to year. This is the company's income statement from their quarterly report. This shows us the first 9 months of 2020, the first 9 months of 2021, the third quarter of 2020, and the third quarter of 2021. So their revenue is pretty much flat, 1.258 billion to 1.286 billion. Of the 1.3 billion of revenue, 1.1 billion is from consumer money transfers. 400 million in North America, 345 million in Europe and Russia, 166 million in the Middle East, Africa, and South Asia, 98 million in Latin America and the Caribbean, 69 million in East Asia and Oceania. Foreign exchange and payment services is 116 million. So if you're in another country, you can change your currency to that country's currency at a Western Union. And some people don't have bank accounts or credit cards, so they go to a Western Union to pay their bills. That was 44 million, and other services is only 21 million. So their bread and butter is consumer to consumer services. That was 1.1 billion. Business solutions 117 million, and other 65 million. So the most common thing for consumer-to-consumer services is if you want to send cash to a friend and your friend lives in another state, you can use your smartphone or go to your local Western Union and transfer money to your friend's name. Your friend would go to their local Western Union and receive cash. The fee could be up to 10% if you send a small amount of money. If you send $100, it might be a $10 fee you have to pay to Western Union. But if you send $1,000, the fee would be less than 10%. Their business solutions is mainly small and medium businesses sending foreign currency transactions. The main thing in other is consumer bill payments. In the third quarter, there were 77 million consumer-to-consumer transactions. That totaled $28 billion transferred. Their digital money transfers have grown a lot since COVID. Most of the company's transactions are people physically going into a location, but digital is growing. The cost to generate the $1.3 billion of revenue was $720 million. Selling, general, and administrative expenses. Examples are the payroll for support functions, also marketing expenses, that was $247 million. Their operating income is up from $285 million to $318 million. They spent $26 million of interest on their debt, which is down from $28 million. In the first 9 months of 2021, they had $27 million in other income and expenses. That included a $48 million gain in the sale of a private company. The cash proceeds were $50.9 million, so that means they paid $3 million for that private company, since they reported a gain of $47.9 million. Also part of other income and expenses were the costs associated with the repayment of one of their secured notes. So when they repay the principal of the secured notes, that's not part of interest expense. Interest expense is only the interest part. Their net income was $233 million. Last year was $229 million. In the first 9 months of 2021, it was $637 million. In the first 9 months of 2020, it was $567 million. Let's look at their statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. And they generated the most cash flow in the trailing 12 months at close to $1 billion. They spend a few $100 million a year on CapEx. This is mostly the investment into their technology infrastructure. Operating cash flow minus CapEx gives you your free cash flow. And they do pay a nice dividend with their free cash flow. It looks like they also buy back common stock. They bought back $400 million in 2018, $550 million, $240 million, and $237 million. When a company buys back common stock, it decreases the shares outstanding and makes your shares more valuable. They've also been paying down some debt. In the trailing 12 months, they paid down $1.3 billion. They issued about $900 million. So they paid down a little over $400 million of debt. They also paid down some debt in 2019 and 2020. They added some debt in 2018. This is their operating cash flow section from their statement of cash flows. This is directly from their quarterly report. This shows us the first 9 months of 2020 and the first 9 months of 2021. And the way you calculate operating cash flow, you start with your net income, that was $637 million. Then you have to add or subtract the non-cash items on the income statement. They had $38 million in depreciation, $121 million of amortization. They passed through that gain on the sale of a non-controlling interest. That was the sale of the private company they were invested in. Since that was a gain on the income statement, we minus that out in a statement of cash flows. This was a cash item, but it belongs in investing cash flow, not operating cash flow. Then we have changes in working capital. So even though they reported an accounting profit of $637 million, they actually generated $686 million of cash flow. This is the investing and financing section from their statement of cash flows, the first 9 months of 2020, the first 9 months of 2021. And the top 3 lines are their CapEx, capitalized contract costs, internal software, $26 million from property and equipment. These are the proceeds from the sale of that private business, $50.9 million. It looks like they purchased part of another company. They spent $200 million. In their investing section, they had a cash outflow of $332 million. In their financing section, they paid $288 million of dividends. They repurchased $236 million of common stock. They added $890 million of debt. They paid down $1.2 billion of debt. So in their financing section, they had a cash outflow of $745 million. This is the equity section on their 9/30 balance sheet. They have $370 million of equity. They raised $930 million from selling their business, and they lost $430 million from running their business. So they have an accumulated deficit. Accumulated deficit is a sum of all their prior net incomes minus the sum of the dividends they paid out. Let's look at the capital structure. $369 million of equity, $2.9 billion of debt. So they're 11% equity, 89% debt. So they're pretty leveraged. Net debt of $1.8 billion. That's debt minus cash. And I gave them the highest whack on Finbox, 8.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $11.5 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $10 billion. We divide that by 402 million shares. And we get a calculated stock price of $25. They're trading at $18, so they're trading at a 27% discount. It's a buy according to the model. Their revenue is projected to increase 1.8%, so I grew their revenue 1.8% for the next few years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, I divided by these 4 revenue numbers. And that comes out to 13%, so they convert 13% of their revenue to free cash flow. So I multiplied their future revenue estimates by 13%. That's how I got their future free cash flows. Simply Wall Street values the company at $34. They're saying it's 46% undervalued. 8 analysts priced this stock, and the average price target is $20. The low is $18, the high is $23. This is where the stock has been trading the last 2 years. So 2 years ago it was about $28 a share. Then it crashed when the entire market crashed in March. And then it came back up to about $26 a share. But it's really struggled since May. There's been lots of selling activity and the stock price has come down quite a bit. Their numbers aren't too bad. They've been pretty consistent. But I think people feel the future outlook of the company is going to be pretty weak because of apps like Venmo. There's less need for Western Union. Their beta is close to 1, so the stock moves with the market. It's gone down 20% in the past 52 weeks, while the S&P is up 16%. The 52-week low is 16, the high is 27. And the stock is trading between its 50-day and 200-day moving average. This is a pretty popular stock. 7 to 8 million shares are traded each day. Of the 402 million shares outstanding, 400 million are on float. Most of the shares are held by institutions, and it has a pretty high short percentage. 14% of the shares on float are shorted. I think most people buy this stock for the stability and the dividend payment. They increase their dividend every year. It was 18 cents in 2017. They're up to 24 cents. Their dividend yield is over 5%, which is half their net income and half their free cash flow, so they can definitely afford the dividend payment. Their industry only pays a 1.3% dividend, and analysts are forecasting the company to grow their dividend from 5.2% to 5.4%. Their employee count is pretty steady since 2016. It was up, but it came back down. They currently employ 11,000 people. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $13,500 today. That's only a 3% annual return. The only insider trading activity in the past year was a sell for 13,000 shares. This has a really high institutional ownership. Nearly all the shares are held by institutions. BlackRock is the biggest shareholder of the company, 13%, 52 million shares valued at $940 million. Then Vanguard at 12%, Capital Research, State Street, and Fidelity. Let's look at their financial ratios. They have a really good PE of 9.0. That's stock price over earnings per share. That means investors are paying $9 for $1 of earnings. Also a really good price to sales ratio of 1.4. That's stock price over sales per share. The market median is 2.8. The average is 9.4. Their price to book isn't so great at 20. That's stock price over book value per share. And the way you calculate book value per share is equity over shares outstanding. Equity is on the balance sheet. It's assets minus liabilities at $369 million. Their tangible equity is negative $2.1 billion since they have lots of intangible assets on their balance sheet. They have a great return on invested capital of 37%. They can cover their interest payments almost 10 times. An amazing ROE of 220%. When you have a lot of debt, you can inflate your ROE, and they have a lot of debt. They have a good current ratio and quick ratio of 1.7, so they can cover their current liabilities with their current assets. Here's a list of their total assets: $1 billion of cash, $3 billion of settlement assets. This is the cash their customers sent over to their friends or family. You'll see the same amount in total liabilities. Property and equipment of $130 million. Goodwill, $2 billion. Goodwill is the premium you pay when you acquire another company. Other intangibles of $440 million. Assets held for sale, $1.5 billion. Let's look at their total liabilities. $440 million of accounts payable. This is how much Western Union owes other companies. $3 billion of settlement obligations. $864 million of income taxes payable. These are taxes due to the government within 1 year. $200 million of deferred tax liabilities. Deferred tax liabilities will increase the amount of taxes Western Union will pay in the future. Deferred tax assets decrease the amount of taxes Western Union will pay in the future. $2.9 billion of debt and $855 million of the liabilities associated with the assets held for sale. In the trailing 12 months, they had $747 million of free cash flow. They have over $1 billion of working capital. Working capital is current assets minus current liabilities. And they pay out almost $400 million of dividend payments. So they have $1.4 billion of funding. So it's unlikely they're going to need debt financing to get through the next 12 months. The best way to look at ratios to compare them to companies in the same industry. There are 63 companies in the same industry as Western Union, and these are the top 20 in terms of market cap. WU spends less in CapEx than the average company. They're much more leveraged than average. Actually, they have the worst debt to equity ratio. They do pay a really good dividend, better than average. Their free cash flow is a lot less than average. Their market cap is $7.3 billion. The average is $22 billion. They rank 15th in market cap. They have a really bad price to book ratio, but their PE, price to free cash flow, and price to sales are a lot better than average. They generate more revenue than the average company. They're not really growing, which is a little concerning, but that's why their PE ratio is so good, because they pretty much plateaued. They have a good ROA and amazing ROE. So to summarize, I have them trading at a 27% discount. And the company does bring in consistent revenue and cash flows, and they're always profitable. I'm a little concerned about the long-term potential of this company, but they've been around so long, and they always find a way to stay in business, so they'll probably pivot again. And they've been spending lots of money trying to build out their digital platform. If they can compete with Venmo, Cash App, and whatever new service comes out, then they should be around for a long time. I rank their free cash flow 7 out of 10, their revenue 6 out of 10, and their ratio is 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.